Now, S&P 500 earnings, they are expected to drop by 7.1% in the second quarter. That's according to FactSet. And that would be the sharpest earnings decline since the second quarter of 2020. We remember what happened back then. Financials and consumer discretionary are expected to lead in the year-over-year growth in revenues, while energy and materials projected to have the most revenue declines. Joining us now is Cole Smead, Smead Capital Management CEO. And Cole, great to see you here again today. Outlook for this quarter looking a little bit muted. What are you expecting here?
Yeah, great to have me on. Thank you for letting me join you. To your point, in the energy space, we can find it probably the most interesting right now because we've seen this big 1 year down move in the oil price, and yet the stock prices are not giving all that up because, frankly, they've paid off their balance sheets in what some would argue is a miraculous way. And yet, at the same time, this might be the most hated bull market in energy stocks in U.S. history. I say that because if you look at how big they are as a percentage of the S&P 500 or investor enthusiasm, I've rarely seen stocks double, triple, quadruple, and no investors are calling their broker begging to buy them.
Well, Cole, I'm going to direct everybody's attention to the Wi-Fi Interactive. Just want to show something quick on our screen here. This is the year-to-date performance in energy. To your point, 2021 was a blockbuster, or 2022 too was also a better year for energy than it was for many of the other sectors. Here's a 2-year look at energy, and we can see Occidental Petroleum. I know that's on your hit list here. But one of the things facing a lot of these oil companies, especially ones that are engaged in the shale oil play in the Permian Basin in Texas, is they've had a really rocky road. Investors, they want shareholder capital returned to them. Meanwhile, the companies don't want to spend too much on CapEx, and it kind of leaves us where we are today. Maybe you could just kind of break down exactly where that is.
Yeah, and don't disagree with you. So a lot of these energy companies, and I was just up at the Calgary Stampede in Canada, where a lot of the Canadian E&Ps get together as well. They're all looking at these investors saying, what should we do? And asking the investors, okay? Now, those investors, to your point, are saying, hey, we want capital return to them, okay? That's primarily via dividends and stock buybacks. Now, the only danger in looking at investors and saying, what do you want, is those same investors back in the 2010s said, drill, drill, drill. And they foolishly followed those investors. So we don't like the idea that investors should dictate the capital allocation of companies. For example, we hear a lot of Canadian and U.S. oil companies say, oh, we need to pay dividends, as though like the gnomes of Zurich who collect dividends are some magical creature out there that you want to have in your shareholder base. We don't agree with that. We think this comes down to what can you get per share in your own stock versus acquiring other oil companies, because the tightness that we're seeing, and a tightness, while, as you just said a second ago in your intro, that China has not come back in a rapid way.
Sure.
The tightness that's still present in the market with Europe tipping into recession, this argues that these markets are very tight despite negatives coming in the way of the oil price. And the question is, who is going to be the king of oil? Who's going to have the most barrels flowing for a very long time? And we think the aggressors in this market, in the energy business, whether it be on the part of investors or the producers themselves that want to get more oil from other issuers, those are the winners of the game.
All right, we were just looking at crude oil, WTI on our screen. It looks like it's about $75 a barrel. Talk to me about the price of oil for a second. OPEC Plus, usually a big factor. We've just had Russia pledging to cut more barrels. I don't think that's supposed to have taken effect just yet. But OPEC Plus, usually a factor in the price of oil. How does this fit into your investor thesis here?
Yeah, the old saying is don't fight the Fed, and I wouldn't fight the Saudis. They play, effectively, they are the Jay Powell in the OPEC Plus model. So that's the first thing I'd say. But secondly, as you think about the overall picture of the supply, you have them out there cutting, and you have American producers who can't produce any more in effect. So I think those two dynamics are very much at play, and demand is increasing, though, as we just talked about, China is not coming back as a demand factor as quickly as thought. So we have supply dwindling slowly, but pretty predictably in the last 2 years, and we have demand creeping up. So we really like that imbalance. It doesn't ever tell you when price is going to change, but you can study supply a lot better in the long run and understand economics. Demand can be a lot more fickle. Those dynamics being at play, I think, is just kind of a godsend But again, most people look and say we're not going to need new supply in the future. They think that we need less energy, that the idea that we're going to go to a far less energy intensive future. And unless we're going to be living in log cabins with no electricity, I think that looks futile. I mean, I was just down in Mammoth, and there's tons of hippies that pull it off all the time. I just don't see most of San Francisco or New York trying to do that as well.
Well, I tell you what, oil is definitely a politicized commodity. We've seen the draining of the SPR, that's the Strategic Petroleum Reserve, that Biden has enacted in order to stabilize oil prices, keeping them from spiking too much. Arguably a political decision. So politics does enter the field quite often. Just tell me how that's playing out as the world tries to march toward a green energy future. Yet, as you just laid out, needs that those dead dinosaurs, because if nothing else, the plastics that we use and many other things use them besides what we consider the typical uses for fossil fuels.
Yeah, you're right. Very politicized. Whether you look at the United States in the case of using the SPR, again, it's a strategic thing. It was used politically. That's the history of the Strategic Petroleum Reserve, is a political tactic. But then you look at places like the UK, where they're continuing to tax production in such a way that it's shutting itself in. The producer's not willing to produce. So I think governmental policies are taking resources and making places in their country unresourceful. If you think of like a California model, there's vast amounts of oil below LA, but we don't produce it, frankly. Now, some could say that's because of real estate values. I wouldn't disagree with that. But the point is not whether we have resources. The point is how we're using our resources. So if you take that and you then pivot and say, okay, let's talk about climate change or decarbonization. The oddity to where we're going is, if we want to have a much larger economy and we're going to use a lot more technology and have a lot greater human flourishing in the future, humans tend to solve the problems they want to solve, which means if we want to solve carbon, we will solve carbon. Now, the knock-on effect, though, is that it means that we're going to have carbon investments for far longer than people think. Solving carbon actually makes the duration of carbon investments much longer because, again, you've solved their ills. And I don't think investors understand that right now. If you want to prove there's not a God, you'll prove it. If you want to prove there is a God, you'll prove it. If we want to go out and solve carbon, I think the profitability of the energy companies are totally misunderstood. And we could wake up seeing them 10 to 12% of the S&P 500 over the next 10 years.
Well, that's really interesting, because I think the last time that happened, I was probably a child in the 80s growing up, although I do happen to know that Exxon was the largest company of the world in 2012, about that time period, overtaken by Apple. So these things go in cycles. If you could just talk to me a little bit about the concentration that you were just talking about. People have been talking about the stock market that we're facing today, the NASDAQ 100, how heavy it is with tech. How does concentration affect the way you're seeing your portfolio?
So in 1980, energy was 30% of the S&P 500. I think if I remember correctly, it was 8 of the 10 largest market caps globally were energy. Okay, and a good just guide to life and investing in the stock market: avoid the 10 biggest market caps in the world, and it's just a good starting place. So I say that because we went from 30% of the S&P being energy companies in 1980. Today it's sitting at call it, I think it's sitting around 4%. Okay, so that's how far we've come in that. Now, again, go back to 2008. I think the high point in 2008, when oil was $147 a barrel, was 15%. So you've seen slowly but surely over time, it's whittled itself down. But the question is that, using the post-Ukraine world, do we look at oil and gas as a 4% importance to the overall economy of the world? And I would argue vociferously, no. We found out pretty quickly it's not. The question is, when do investors change their enthusiasm? Now, invert what we just talked about on the energy market caps as a percentage of the S&P 500. Again, the 10 largest market caps in the world are a fool's strategy in the long run. So that was Japanese stocks in the late 1980s. That was U.S. tech stocks in the late 1990s. It is American tech dominance today. And so the dangerous part of the concentration of the S&P 500 is it's so housed in the 10 largest market caps. It's a nightmare for the S&P 500, and it's a nightmare for investors concentrated in those 10 largest market caps. That's one of the better things going on for energy. You don't have to wonder if you're in for hell. You're not part of the 10 largest market caps right now.
Really interesting, and I was impressed how you were able to rattle off a number of those statistics just off the top of your head. I want to shift gears a little bit. One field that has been highly correlated with the tech sector this year is actually home builders, and it's not necessarily because they're doing the same thing, but let's take a look at the Wi-Fi Interactive one more time. This is a year-to-date performance of home builders, and we have Hovnanian here at 160% in the upper left, Beazer at about 130%. KB Home 70%, Toll Brothers 65%, goes down from there. But this is another secular theme that I know your firm has centered on, and that is the lack of housing for new entrants in the market. That would be millennials and Gen Z over the decades. So how is this playing out in your portfolio?
Yeah, we talked about supply with energy. Remember I said that you could really focus on supply and understand economics a lot better through supply versus demand is fickle. That has been housing this year. If we sat here 2 or 3 years ago and I said, hey, we're going to have 6 or 7% mortgages, anybody in their right mind would have said housing is going to get killed and home builders are going to get crushed. Now we sit at those rates, and to your point, the home builders are sitting at all-time highs because what they produce is scarce. And that's all you really want as an investor, is to have a business where what you produce is scarce and needed in the open market. That is exactly what's going on with home builders. So even at lower volumes this year, they're producing massive profitability because, to your point, the millennials are coming, is how I think about it. And the millennials are running into very tight supply, which means that people will buy homes based on needs, not based on wants. And when babies are born, babies build houses. And that's the great part to this. Human flourishing causes greater economics and housing. So just like I said, we think humanity is going to flourish and we're going to need a lot more energy. We think humanity is going to reproduce and flourish, and we're going to need a lot more housing, and we're just doing that on very tight supply.
Yeah, and mortgage rates, then, not the headwind that people thought. Really appreciate your insights here, as always. So that was Cole Smead of Smead Capital Management, the CEO.